All right, let's talk about Corsair. They're a huge name in PC gaming and creator hardware, and they just dropped their full-year financial results for 2025. Today, we're going to dig into those numbers, unpack the strategy behind them, and really figure out what it all means for the company's future.
Okay, but first, the usual but very important heads up. This is all for educational purposes. It is absolutely not financial advice, so please always do your own research. So, here's our game plan. We'll kick things off with the huge headline numbers from 2025, then we'll figure out where all that growth actually came from. We're going to hear what the top brass has to say about their strategy, see how that's shaping their 2026 forecast, and wrap up with their new plans to give back to shareholders.
Let's start with the big picture from 2025. And to put it simply, the headline numbers were, well, they were pretty darn impressive, starting with some serious growth at the top.
The company locked in a really strong 12% jump in revenue for the entire year. We're talking total sales hitting nearly $1.5 billion. Right off the bat, that tells you demand for their products is solid.
But, it's not just about sales. They also hit a record 28.9% gross margin. Now, what does that actually mean? It means that for every single dollar of product they sell, they're keeping more of it as profit before other costs. For a hardware company, that is a huge, huge win.
And that awesome profitability, it flowed straight down to the bottom line. Get this, a massive 84% jump in their full-year adjusted EBITDA. That's a key number for core profit. And this wasn't just meeting expectations, it completely blew past the high end of their own forecast.
So, yeah, a great year all around. But the really crucial question is, where did all this growth actually come from? Let's peel back the layers a little bit.
Corsair's business is really split into two main buckets. The bigger piece of the pie, about 2/3 of their revenue, is their gaming components and systems. Think memory, power supplies, PC cases, all the stuff you put inside your rig. The other third comes from gamer and creator peripherals. The stuff you touch, like keyboards, headsets, and all that killer Elgato streaming gear.
And when we look at how each of those segments grew in 2025, a really clear story emerges. That larger components and system segment was the absolute powerhouse, growing by a powerful 16%. The peripheral side grew too, but at a much more modest 4%.
Okay, so we've seen the what. Now it's time for the why. To really understand where this company is headed, we need to get inside the strategy that's driving all these results.
So what's the game plan coming from the C-suite? Well, it's really a tale of two things. Incredible execution right now, and a very deliberate pivot for the future.
According to CEO Thi La, a big part of their success was just rock-solid operational execution. He points to things like smart inventory and being flexible with their supply chain, which was absolutely critical when memory chips were hard to come by. That kind of discipline is exactly what allowed them to crush expectations in the fourth quarter.
Now, we've thrown around that term adjusted EBITDA a few times. So what the heck is it? Well, in simple terms, think of metrics like non-GAAP or adjusted as a way to strip out all the one-time or non-cash expenses. It gives you a much clearer picture of the core day-to-day profitability of the business. It helps everyone see the real underlying performance trends.
And this quote is the key to their entire future strategy. The CEO is basically signaling a massive shift in focus. It's becoming less about just pure hardware volume and more about investing in platforms that can scale. Things like Elgato's Stream Deck. The goal here is to build a business with higher margin products that can deliver much stronger returns in the long run.
This strategic pivot becomes totally crystal clear when you look at how the company is guiding Wall Street for the year ahead.
Their forecast for 2026 really tells a tale of two different businesses, and it perfectly reflects that strategic shift we were just talking about.
Here's the official guidance. Notice anything interesting? Right there in the middle, net revenue is expected to be slightly lower than it was in 2025. And yet, that adjusted EBITDA, that core profit number, is projected to be flat or even grow. That's a super powerful signal about their strategy.
So, why would revenue dip while profits hold strong? Well, Corsair is expecting double-digit growth in their high-margin peripheral segment, but they're being a lot more cautious about the lower-margin components business, partly because of those ongoing chip shortages. This is the strategy in action. They're prioritizing profitable growth over just chasing sheer revenue volume.
Finally, with such a strong financial year in the books, the last piece of the puzzle is how the company plans to use all its cash to benefit its owners, the shareholders.
CFO Gordon Mattingly sets the stage perfectly here. The focus is all on financial discipline and maximizing returns. See, it's not just about making money, it's about being smart with it.
The first sign of this discipline? Paying down debt. The company managed to reduce its total debt by over $52 million during 2025, which makes its balance sheet significantly stronger.
And here is the big news for investors. The board has authorized a new $50 million share repurchase program. This allows the company to go out and buy back its own stock from the open market.
Now, what makes this announcement so significant is that it's the company's first ever share repurchase program. A move like this is a huge signal from management that they believe their stock is undervalued and that buying it back is a fantastic use of the company's cash.
And this all brings us to the final crucial question. Corsair is making a clear strategic pivot. They're moving away from a pure hardware volume game and toward a future built on higher margin, scalable platforms. So is this the move that will build a more resilient and consistently profitable company for the years to come? That's the question investors will be watching very, very closely.